Let's say you're nearing retirement and you have been diligently investing your money and you built yourself a nice nest egg. Some of you might feel pretty confident that you won't outlive your money, but others may not be so sure. And with all the uncertainty in the world and the markets, and there's a lot, you might be wondering what you can do to make sure your nest egg is intact when you need it. Joining me is Ingrid McIntosh. She is head of mutual fund strategy at TD Asset Management. And we're going to talk about the things you need to pay attention to. I particularly love this conversation because, again, if somebody is what we said here, if you are near retirement, early retirement, there's some really important things you need to pay attention to. And just what are they?
Well, I think the most important thing is you've probably never had as much money as you're going to have right now, and you have no more time to make it up if anything should happen to that portfolio. So it really is about making sure you don't blow it.
Okay, so it's you never want to blow it, but blowing it when you're 30 is okay. Blowing it when you're 66, not okay.
No time to recover.
I want to bring this a chart up that you've brought in because, again, I want to just sort of illustrate this because you have two examples here we're showing. So tell me what we see.
We're talking about decumulation. So as you highlighted, when somebody's in the investing stages of their lives, there's market volatility. And as you're growing a portfolio over time, it's okay to have ups and downs because you're not touching that money. Once you're in retirement...
I'm just going to pause for this. So just so people know, this is not your whole life. This is just from the time of your beginning of your retirement.
Exactly. So what you have here is two 10-year pictures. Kim on the top, her story plays out between 1993 and 2002, and the lower line is a story that's playing out between 2001, 10 years thence. If you look at these two time periods and you didn't touch your money, you would have similar returns. But what's different about these two individuals is they're drawing their money down over this time. They're withdrawing money. So if you have strong markets early on in the period of drawing down your money, it's going to last longer and there'll be more of it there. In the case of the lower line, we had some rough markets in those first few years, and that asset base was impaired for the investor, which meant he didn't have as much money over time. So when you start pulling the money out of your portfolio, volatility matters a lot more, and drawdowns hurt you much more because you're taking the money out while it's been dropped down.
And the thing, of course, is just basic things for me, is that when you take money out, you've got less money to work with, right?
Exactly.
So that it doesn't grow as well. And then take a big hit in the beginning, it's just not good. So I want to talk about how to solve for this, because it's nice to highlight the problem. People would like to know exactly what to do with that as well. But this is something that is very important to institutional investors, and this is something that you've got experience in.
Thank you. So from an institutional perspective, they're not thinking about, pension plans aren't thinking about the best return that they can get for their money necessarily. They're thinking about the obligation that money has to fulfill for the plan sponsors that they're supporting. Similarly with an individual investor, you're thinking about your retirement, you're thinking about the goal that you have. And as you move towards retirement, depending on your financial situation, you are perhaps less interested in the upside. You may not need much more upside, but you become increasingly more concerned about the downside, which affects how you think about investing your portfolio.
I think the other thing for people too is, and this is tough. There's a lot of people out there who are do-it-themselves investors. They want to manage the stuff, and they think, yeah, I got this, I get it. So the point is, don't take too much risk. And the balance here is you got to take some risk, or else you're not going to make any money. But risk is complicated.
Right. So when you're growing your portfolio, we define risk as volatility. What is the risk in the market? And the environment that we're in right now, with absolute low interest rates, mind you, they've come up a little bit since Donald Trump's election, but historically very low interest rates, which means that savers are penalized. Your ability to move to a conservative investment and still have that money do what you need to do for you is significantly impaired. Alternately, that means people need to take more risk on the equity continuum when they are in retirement, and that's where the real challenge is having those choices. Our parents could very comfortably be in low-risk investments if they'd built a nice nest egg. Now we talk about
a return on
they've got
bonds,
return, got a 4% GIC or 5%, so things were very comfortable. Now people need to weigh market risk against the risk of not having enough.
Let me ask you, and bias out there. I mean, you work for TD. You had the mutual fund strategy piece, but how do you do that? How do you actually engineer this so that I'm actually getting the right amount of risk and I'm not getting hurt and I don't take that big hit?
It's really hard. It's really complex. There's asset allocation decisions. Where should you be in the market based on what you see going on? But even when we think about that, there's other factors to consider. How do you manage for that downside? At TD, we're always thinking about solving for the customer need. So that might mean designing an equity strategy that's built of equities that are maybe going to be less volatile, go down less, or even more broadly build funds or solutions where we combine stocks and bonds, but we also use complex option strategies to help manage that downside.
Right, so it's designed for some of that lifestyle.
It's engineered to try and figure out the best mix of risk for our customers at their life stages.
And how much, I mean, not to prognosticate too much, but I mean, we're in a whole new age of uncertainty. I mean, I would say have had pretty calm waters for a decade or more, and suddenly things have gotten turned upside down. So we could see a lot moving around.
We could see a lot moving around. We have absolute or near lows in interest rates, and the direction is likely higher, which means that if you are holding fixed income securities in the short run, you're going to have potentially a negative return. The good news is, as you reinvest those dollars, you're going to do so at higher interest rates, but we're also at very high in equity markets. And we have a new president-elect in the US, and let's face it, there's a lot of tail risk around that. There's tail risk around Europe, so there's still lots of opportunity for volatility going forward, and it's a stressful time for retirees and pre-retirees.
And I know you're a real advocate for, talking to someone and getting some professional help.
Getting the advice of a financial planner or an advisor to help you understand and navigate those waters, really, really important, both in terms of making the right decisions, but also giving you the confidence in those decisions so you're not doing things that might impair your long-term financial success.
Great information as always, Ingrid. Thank you very much.
Thank you.
Ingrid McIntosh, she's head of mutual fund strategy at TD Asset Management.